Now we'll come to IAS 40. IAS 40 is investment property. Very easy standard. Most of the principles of IAS 16 would apply. What is IAS 16? Property, plant and equipment. Okay. So wherever investment property would be measured at cost model, entire IAS 16 will apply the way we have applied in property, plant and equipment. However, investment property under this standard can be measured at fair value also. So in that case, the investment property will be valued at fair value. So some extra thing you have to learn. What distinguishes an investment property from a property, plant and equipment? This is a building which you come and attend every day, the classes. Is it investment property or is it property, plant, equipment for us? Is it property, plant, equipment for us? Why? Why do you think it is a property, plant and equipment for us? Because you have not rented it. You have not invested for capital appreciation. Rather, you are using it for production, rendering of service, administration purpose. Okay, but not for rental, right? But what if half day I use and half day if I give it on rent? Then what if half portion I use it and half portion I give it on rent? Then there are some critical issues that will arise in such situation when a property may be used some portion of the day for own purpose, some portion of the day for rental purpose, some period in a month for own purpose and some period in a month for rental purpose, some portion physically for own purpose and some portion for rental purpose. Okay. So we will learn about how to identify whether a given property is investment property or property, plant and equipment. So our major efforts will be first invested in understanding what is investment property, then cost of the investment property, initial measurement principle, subsequent measurement principle, transfer from one classification to other classification. Like for example, the owner occupied property can become rental, investment property, vice versa. Investment property can become owner occupied property. So that we will discuss under transfer, and then we'll discuss about derecognition and disposal. And the last part, as usual, disclosures. Okay. So standard is very simple. If you have studied IAS 16, then it will make your task easier. The objective of the standard is to prescribe the accounting treatment for investment property and the related disclosure requirement. Investment property means the investment in land or building or both. Only land or only building or both, with the prime objective of earning rental income or capital appreciation, and not with the objective of using it for business or to sell in the ordinary course of business. Okay. So it is mentioned in your note also that recognition and measurement principle prescribed in this standard are closely aligned with IAS 16, that is property, plant and equipment. What are the important areas that we are going to pay special attention to? Exercising judgment in determination of whether or not a property qualifies to be classified and accounted for as investment property. So first few minutes, 1 and 2 pages almost, we are going to discuss whether a given property can be classified as investment property or not. Okay, so keep thinking. For example, there is a hotel. Is it an investment property? Okay. Or this is my classroom. Half of it is given on rent, half of it is used for teaching by ourselves. Whether this will be treated as investment property or not. Okay. So this first few minutes will be discussing such typical issues. And then reclassification. Next part of this chapter would be reclassification of asset into and out of the category of investment property. So owner occupied property to investment property, inventory to investment property, investment property to owner occupied property, investment property to inventory. These four movements we are going to discuss. Okay. Owner occupied property or inventory may become an investment property, or an investment property may become owner occupied property and inventory. And then if you see the last 2-3 pages of this chapter, they're all about disclosures. General disclosure, and then disclosure if you follow cost model, and disclosures if you follow fair value model. Okay. So long list of disclosures is there. First few minutes quickly we'll go through carrying amount, definition of carrying amount, and some more definitions. Those definitions which we have discussed in length in other standards before coming to this, we are not going to spend time on that. For example, carrying amount. Carrying amount means the amount at which an asset is recognized in the statement of financial position. Means basically cost minus accumulated depreciation minus accumulated impairment loss, in case if you are following cost model. Okay. And then what is the meaning of cost? Right here, same as IAS 16. Same as IAS 16. IAS 16 we have discussed what is cost. It may be cash or cash equivalent paid. In case of exchange transaction, fair value of the consideration given to acquire the asset at the time of acquisition or construction, or where applicable, or the amount attributable to that asset when initially recognized in accordance with the specific requirement of other IFRS. For example, IFRS 2. What is IFRS 2? Share based payment. If you have acquired investment property by issue of share, you acquired a building by issue of your company's share, which standard will become applicable for initial measurement of that? This IFRS 2, share based payment. Because there, in case if we have made payment by issuing share, that standard becomes applicable. Okay, what is fair value? Discussed so many times, is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Which standard will talk about this fair value? IFRS 13. Okay. Now we'll come to the main definition. In order to check whether a property is investment property or not, keep this definition in mind. Investment property is a property. But which property? Only land, only building, or a part of building, or both, means land and building, held by the owner, that is the one who owns the asset, legally owns the asset, or by lessee as a right of use asset. Owner. Who is an owner? Who legally owns the asset. Okay, control means lessee. Is it right? Lessee as a right of use asset. Now this lessee as a right of use asset, we will discuss in IFRS what, 16 or 17? IFRS 16, IAS 17. So if IAS is applicable to your syllabus, apply IAS 17. But if IFRS 16 is applicable to your syllabus, then you will apply IFRS 16. So in this chapter, at few places, this sentence will appear, or by the lessee as a right of use asset. So in that case, we will just simply refer IFRS 16. When you will study that, you will understand in detail about this concept. Because sometimes what happens in a finance lease, basically, at least some basic knowledge you have about finance lease, the asset is capitalized in the books of lessee. Is it right? Instead of lessor. So that is why I said by the owner. Normally in case of operating lease, the asset is capitalized in the books of owner, lessor. And in case of finance lease, it is lessee. Earlier, when IAS 17 was there, they had used the word or by finance or by lessee under finance lease. And since this IFRS 16 has come, there is a small amendment in this standard. Instead of using the term finance lease, now they are using the term lessee as a right of use asset. Okay. What is the purpose of this asset? Purpose number 1, to earn rental income. And purpose number 2, capital appreciation. Or it can be both. So if I exclude this lease from our discussion right now, it means investment in either land or building or a part of building or both by the owner to earn rental or for capital appreciation. To earn rental or for capital appreciation or both. Okay. Lease will not discuss because that requires a more understanding of IFRS 16 rather than for use in the production or supply of goods or service or for administration purpose. If it is used for this purpose, we will classify it as property, plant and equipment. And if it is used for this purpose, we will classify it as inventory. Okay. If it is held for sale after fulfilling the requirement of IFRS 5, then we'll apply IFRS 5. What is IFRS 5? Non-current asset held for sale and discontinued operation. So there is some similarity between this standard and IFRS 5. Here also my objective is to invest in a property to sell it and make capital gain. In IFRS also I am holding a non-current asset to sell it. Is it right? But in IFRS 5 there are some conditions to be fulfilled for an asset to be called non-current asset held for sale, and those conditions are different from the definition of investment property. So if I invest in land and I want to sell it after 5 years, it will be investment property, but it will not be non-current asset held for sale, because non-current asset held for sale, the management should try to complete the sale within a period of 12 months. And they must actively look for a buyer to complete the sale. That is not a requirement of this standard. Okay. Then the standard gives you some examples of investment property, because these can be questions for you in the exam, like a true false question or a MCQ question. Following is investment property. Some example and you have to choose which is the right answer. So first example is land held for long-term capital appreciation. Land held for currently undetermined future use. Undetermined future use. If your future use is determined, then you follow that classification. If you want to use the land for construction of a factory building, then you will follow PPE. But you are undecided. A building owned by the entity or a right of use asset related to a building held by the entity and leased out under one or more operating leases. A building owned by the entity leased under one or more operating leases will be investment property. Operating leases are usually for a short period, where the amount that you recover from one lessee is not sufficient to cover the fair value of your asset. A building that is vacant but is held to be leased out under one or more operating lease. So purpose also you have to see. Building is presently vacant, but what was the purpose of investing in this building? So that you can lease it out to one or more operating leases. Next, very interesting, property that is being constructed or developed. Property that is under construction or development for future use as investment property, that will also be classified as investment property. Okay, and then this standard will become applicable. Same property, if it is used for future office purpose, factory purpose, then will be classified as property, plant, equipment. Capital WIP, yes, this is the capital WIP of investment property. If it is used for leasing purpose, operating leases, but if it is used for your own business purpose in future, then it is capital WIP of PPE, right? This was definition of investment property. Opposite of investment property is owner occupied property. So they have used these two terms, investment property, owner occupied property, property owned by the owner or by the lessee as a right of use asset for use in the production or supply of goods or services or for administration purposes. So either the owner or the lessee as a right of use asset, which means like finance lease. If they are going to use it for their own production purpose, rendering of services or for administrative purpose, welcome. You will not apply this standard. Then you will apply IAS 16. Then you will apply IAS 16 or IFRS 16. Okay. Now I have also made a list of those assets which will not be classified as investment properties. Okay. The first one is the easiest one, the property intended for sale in the ordinary course of business or in the process of construction or development of such sale. Which standard will apply here? IS2. Property constructed on behalf of third parties. Construction contract. IFRS 15. IFRS 15. Owner occupied property, including property for future development and subsequent use as owner occupied property. So owner occupied property is not an investment property. Even if you are developing a property to be used in future as owner occupied property, will be also not an investment property. Now, property occupied by the employees, whether or not the employees pay at market rate, is also not an investment property. If the company's property is given to employees, owner occupied property awaiting disposal, owner occupied property awaiting disposal will not come under this standard. And if it fulfills the definition of IFRS 5, non-current asset held for sale, then this will get accounted under there. And property that is leased to another entity under a finance lease, it will not be treated as investment property in the books of the lessor. It will be shown as a receivable. Okay. Now one paragraph I have written from my side. Difference between owner occupied property and investment property. One student wants to ask a query. Okay. This is specifically given in the IAS 40. So suppose your company has constructed a property, which many companies do for their employees, where they can stay. So that is more like you are using the employee services only for your business. So that has been specifically mentioned that will not be treated as investment property. Okay. IAS 16. IAS 16 will apply. All physical assets, IAS 16, intangible asset, IAS 38. Okay. Now one paragraph from my side also. Differences between owner occupied property and investment property. Okay, so I have made a very detailed list. What are the differences possible? Some we have discussed, some we will discuss. An owner occupied property is property held by the owner or by the lessee under a finance lease. You write IFRS 16, refer IFRS 16, for use in the production or supply of goods or services or for administration purpose. Wherever lease will be mentioned, you refer IFRS 16. An investment property is a property being land or building or part thereof or both held by the owner or by the lessee under a finance lease to earn rental or capital appreciation or both, rather than for use in the production or supply of goods or services or for administrative purpose or sale in the ordinary course of business. This was the difference in terms of their definition, copied from definition paragraph. Now we'll come to the understanding part. What are the key differences? Owner occupied property do not generate independent cash flows from other assets of the entity. Is it right? In case of owner occupied property, there are so many assets which work together to generate the cash flow. But in case of investment property, there is a building which you have given on rent. So that building generate independent cash flow. It may not be based on, dependent on other assets of the entity. So investment property is held to earn rental or capital appreciation, generating cash flows independently from other assets of the entity. Third difference, owner occupied property is used for actively running the business, right? Whereas investment property is used for earning a passive income, such as rent or capital appreciation. Fourth difference, expected to be used over a long period. Owner occupied property is expected to be used over a long period. So when you construct a factory building or an office building, your intention is to use it for a very long period of time, unless the situation demands you to sell it or move to another premise. Okay. So here, even though there may be some appreciation in the value of the property, you are not going to encash it. Are you going to encash it? If Mukesh Ambani has an office in Nariman Point, the value of that property has gone 15 times. Is he going to sell it to make the capital gain? Normally not. So these are not expected to be encashed in the normal course of the business. Whereas investment property, if it has been investment property and if you find that the prices have gone up, you might like to monetize that. You might like to encash that benefit, okay, and earn capital appreciation. Point number 5. Under the revaluation model, which we'll discuss after some time, increase in carrying amount are recognized as revaluation surplus. Now this we will discuss later. Now also understand, if it is owner occupied property, IAS 16 will apply. And in case if you are following revaluation model, means you are trying to bring the book value close to the fair value, the change in fair value, if positive, means appreciation, will be carried to revaluation surplus account in the OCI and then in the statement of changes in equity. But if you are following fair value model under this standard, and if there is an appreciation in the value of the property, you are going to charge or credit to SOPL, statement of profit and loss, not to the revaluation. Is it right? not to the revaluation account. Paragraph 4 now. Interesting paragraph. Use of judgment in identifying investment property. Sometime we have to apply our judgment in seeing whether this property will go under investment property or owner occupied property. Okay, like for example a hotel which you give to your guest on a daily rental basis. Okay, or half of your building is given on rent, half you have occupied. Half day you are using, half day someone else is using. Some days in a year you are using, some days it is given on rental. Okay, so in this case, what is investment property? Okay, so broadly speaking, a property is classified as investment property or owner occupied property by using the judgment. Sometimes judgment may be allowed. A property which is used as investment property and owner occupied property is accounted for separately. Now see, this is the first principle. If each element is capable of sold independently. Like in this building, there are two floors, first floor, second floor. First floor owner occupied, second is leased out. What will be the classification of this building? If each part is capable of being sold independently, I can sell this part, I need not sell the first part, then my life is easy. This will be classified under investment property and this will be classified as owner occupied property. Okay, owner occupied property. But what if they can't be sold independently? Like this classroom where you are sitting. Okay, this is a classroom where you are sitting right now, and I put two partition in this classroom. One partition, small partition given on rent, then this middle partition I am using for teaching purpose. Again the last partition given on rent because we don't require. Now it is just two partition we have put here. What will be the classification now? Now they can't be sold independently. Nobody is going to buy this property from me unless he has to buy this also. Otherwise, he will not be able to approach this. Or if he buys this, I will disturb him every day. But I want to enter. Okay. So this time judgment will be required. Whose proportion is more? Whose proportion is more? And accordingly, you do the classification. If each element cannot be sold independently, if this can be sold independently, this can be sold independently, and this can be sold independently, then you can show this as IP, this is OOP, this is IP. But if they can't be sold independently, is classified and accounted as either investment property or owner occupied property depending upon the significance of the intended use. So suppose this area is, let's say, 90% and this 2 is 10%, then it can be treated as OOP. Okay. First, you complete this diagram in your book. If you have not completed this portion, write rented, this portion write owner occupied, and this portion rented. One student has also asked this question: if from morning till afternoon it is rented, somebody else comes and teach in the same classroom, and from afternoon till night I teach, what will be the classification? Same answer, depending upon the significance of the intended use. Then the student will ask, what if it is 50-50? 12 hours you are teaching, 12 hours you have given on rent. If I say it is given partly on rent and partly owner occupied, then he asks, what if it is exactly 50% given on rent and 50% owner occupied? What if it is given on timely basis? First 6 months rented, next 6 months used by us. Okay. Keep thinking and I will answer that question in a set of questions appearing below. One more question. Okay. Business model is of renting. Business model itself is renting. So investment property, passive income. So just check, is it meeting the definition of investment property? The purpose. It's given property in land or building. Okay, see the definition. Property which is land or building or a part of land and building held by the owner or by the lessee as a right of use asset to earn rental or for capital appreciation or both, then it is investment property. So your business itself is to rent the asset, then also investment property standard would apply. Which part B? So not selling. You asked me sell. You asked used in supply of. Okay, so there is an example on your question. We'll discuss that and then you can repeat your question. Okay. Because if I answer right now, then how will I ask you that question which is going to come? So anyway, IFRS 3 business combination. IFRS 3 deals with business combination. Now similarly, just like we discussed the other part, if you acquire a property in a business combination under IFRS 3, even that time you may require to apply your judgment whether you want to treat it as owner occupied property or investment property. Now your question was about some services. Okay. So let us discuss this paragraph and then maybe you'll get your answer. That example of say hotel business is same what you are asking. They are having a business of giving on rent only on a daily basis. Is it right? But then we have to see what is the level of ancillary services you are providing. What is the level of ancillary services you are providing? Level of ancillary services can be very insignificant. You have given a property on rent. Okay. That is your question and that is your business. What are the ancillary services you are providing? Like in a hotel, they provide a lot of ancillary services. When you go there, there is a person who will bring your bag, take it to the room, clean your room, provide you food, water, milk, anything that you need. They will give you a lot of other services. But sometimes suppose you have taken a flat on rent, like many of you may be living in a rented flat. Does your landlord give you a lot of services? He has just provided you a blank flat and now it is up to you. So the answer is to your query, if your business itself is giving on rental basis, apply this line, ancillary services. The property will be classified as investment property. But if the nature of services provided are significant, like in case of a hotel, in case of service apartments, where they do a lot of cleaning work, okay, they'll maintain it on a daily basis, they will provide food, other services, then the property is classified as owner occupied property. And then there is a question on this point, which actually we have already discussed, but again there are some tricky issues involved. X Limited runs a property as hotel. It has engaged a service provider which manages the hotel including the guest services. The service provider provides reception, booking, and cash management service. The company controls and services rendered by the service provider and also periodically assesses the service quality. This will help you to reach your answer. The company controls and services rendered by the service provider and also periodically assesses the service quality. The service provider also provides a guarantee for minimum occupancy at an average rate of 50%. The service provider will get special commission for occupancy over and above 50% if it gets 2% of revenue for providing minimum guarantee. Should the entity treat the hotel as an investment property? Now these are the case studies. Can it be treated as investment property? Owner occupied property. Why? This company is actively controlling the services rendered by the service provider and also checking the quality of the services. So you are not just a passive investor in that building, but you are only sharing the revenue with that service provider as a motivation for him to maintain the quality of services. So therefore, in this example, it will not be treated as investment property. It will be treated as an owner occupied property. Write down 5 small sentences. Right there. The facts and circumstances of the case. The facts and circumstances of the case does not prove that the entity is a passive investor. Does not prove that the entity is a passive investor. The entity has simply offered performance linked commission. The entity has simply offered performance linked commission. This of course has the effect of reducing variation in cash flows. This of course has the effect of reducing variation in cash flows. In accordance with IAS 40, X Limited does not become a passive investor because of this revenue management arrangement. The property is not classified as an investment property. The property is not classified as an investment property. You can write IP in this chapter. Wherever investment property you have to write. To save time in the class. But in the examination, do not write short forms. Okay, dear student, come to next paragraph. Intra-group property lease transaction. Very interesting again. Intra-group property lease transaction. Suppose there is a parent company or holding company and it gives asset on lease to subsidiary. Okay. So how will the accounting be done in the individual financial statement and in the consolidated financial statement? In the individual financial statement of parent company, this will be treated as investment property because it fulfills the definition of investment property. But what the subsidiary is doing with that property? Is it again leasing it out to someone else or is it using for business purpose? But subsidiary is suppose using for business purpose. Then in the consolidated financial statement, which is the financial statement of the group as a whole, you have to see as a group what is the use of that property. And if subsidiary is using it as owner occupied property, then for CFS purpose, the classification will be that of the owner occupied property. This diagram I have drawn in your book. We'll take some example to make our understanding better. Intra-group property lease transaction. Either the parent has leased out to subsidiary, subsidiary has leased out to parent, or one subsidiary has leased out to another subsidiary in the same group. If the transferee entity uses the property as an occupant, transferee means the one who has taken on lease. The property is accounted as owner occupied property in the CFS. The transferor entity or the lessor treats the property as investment property in the individual financial statement, not separate financial statement. That is a different concept. We will call it individual or standalone financial statement. Okay. Solve this question for you. Individual financial statement or standalone financial statement is not equal to separate financial statement. We'll discuss that in a separate standard. Okay. Solve this question. Let me check who can answer it. S1 Limited lets out a property to S2 Limited under operating lease. Both are subsidiary of P. Analyze how would different companies treat the property in their respective separate financial statement and consolidated financial statement. Who is going to prepare the CFS? P Limited. Okay. How will S1 disclose this in its books? S2 and P in the CFS. S1 will disclose it as investment property. S2, nothing, because in operating lease the lessee does not capitalizes the asset. And in the CFS, P Limited will disclose it depending upon what is the nature of use by S2, which we will assume for production rendering of services owner occupied. So the three answers would be as follows. In the SFS of S1 Limited, in the SFS of S1 Limited, property under operating lease is treated as investment property. In the SOFP of the company. Next line. In SFS of S2 Limited. Asset under operating lease is not recognized as an asset. And then in CFS of P Limited Group, in CFS of P Limited Group, operating lease transaction between S1 and S2 is eliminated. Operating lease transaction between S1 and S2 Limited is eliminated. CFS in the CFS investment property classification, in the CFS the investment property classification by S1 Limited is also eliminated. The property is classified as OOP. The property is classified as OOP, owner occupied property. Done. So this first few minutes we spent on understanding what is an investment property. Okay. Now the next paragraph is initial recognition. For all the assets that appear in our balance sheet, one feature is common. It is probable that future economic benefit associated with the investment property will flow to the entity. For any asset on the entire asset side of the balance sheet, it should generate future economic benefit, and the cost of the investment property can be measured reliably. Second part may not be very difficult, but sometimes the first part you have to check it carefully. Will it generate future economic benefit? If the answer is no, then you cannot recognize it as investment property. Okay. Then I have written one more note in your book. Expenses like ceremony expenses, repair maintenance expenses, etc. will be expensed off as and when incurred. There is one example on this initial recognition. I'll read from your book. Okay. I'll read from your book. Modern Ventures PLC constructed a building at a cost of $2 million with an intention to let it out. So what will be the classification? Normally IP. Okay. But there is a note. Municipal authorities contended that it has not followed the stipulated procedures or plans and ordered Modern Ventures to demolish a part of the building. After you've constructed the building, then the municipal authority said, no, it is illegal. Demolish the building. Construction is complete. Only an approval from the municipal authorities in the form of a completion certificate is to be received. Should Modern Ventures recognize the property as investment property? So first point is, it is probable that future economic benefit will flow to the entity. And because the municipal authorities have raised an objection and they have asked the company to demolish a part of the building, means future economic benefit has become uncertain. So therefore the answer is, even though cost can be measured reliably, but future economic benefit is uncertain, it cannot be recognized as investment property. For the expenditure they have incurred, they have to apply the impairment testing. Is it right? So I have written an answer. If we look at the conditions for recognition, the second condition is satisfied. That is, the cost can be measured reliably. However, it is not yet probable that future economic benefit associated with the property in the form of rent income or capital appreciation will flow to the modern enterprise venture. The first condition is not satisfied. Modern should not recognize the property as IP it may also have to consider an impairment loss. So what about the expenditure that you have incurred? Apply the impairment loss testing. Now come to measurement at initial recognition. So this is very important. In this chapter, an investment property initially will be recognized at cost, like IAS 610. Initially not at fair value. Subsequently, you can choose an accounting policy. Okay. What about the transaction cost? Because when you buy a property, you have to incur professional fees. Okay. Legal fees, property taxes, consultants fees, brokerage, commission, that shall be added to the cost of the initial measurement. Okay. Now we'll solve one small example appearing in your book. Question number 4. Just there only. I think the answer is printed. Enjoy. X Limited purchased a building for 30 lakh dollar. My God, very expensive. The purchase price was funded by a loan. Property transfer taxes and direct legal cost of $1 lakh and 20,000 respectively were incurred in acquiring the building in 2000 X1 and 2000 X2. X Limited redeveloped the building into retail shops for rent under operating leases to independent third parties. Expenditure on redevelopment were $2 lakh planning permission, $7 lakh construction cost. Underline, including $40,000 refundable purchase taxes. The redevelopment was completed and retail shops were ready for rental on September 2. What is the cost of the building at initial recognition? A similar question you have done in IAS 16 also. All cost you will add and minus refundable purchase tax of $40,000. So only check in your calculator 30,000 plus 1 lakh plus 20,000 plus 2 lakh plus 7 lakh minus 40,000. Is the answer $39,80,000? Is it right? Checked or trusted? Checked. Now next is special issues. So next few paragraphs will deal with some special situation. Like for example, consideration to acquire an investment property is in the form of shares. Previous example was you incurred in cash and cash equivalent. Now you acquired investment property and you issued the shares of your company. Which standard will apply for this? For initial recognition, IFRS 2, share-based payment shall apply. Next is self-constructed asset. If you don't want to read so much, apply all principles of IAS 16. Okay? Direct material, direct labor, direct expense, those overheads which can be apportioned will be added. Internal profit will not be included. Abnormal wastage will not be included. Okay? Interest can be included if it is a qualifying asset, which normally it would be. Okay? So that is about cost of self-constructed asset. It's written in the notes also that cost of investment property that bears the characteristics of a self-constructed asset principle under IAS 16 shall apply until the date of completion. Any abnormal amount of wasted material, labor or other resources incurred shall be excluded. On the asset being developed fully and qualifies to be classified as investment property, accounting for such asset would be governed by this standard. Once the completion is over, you classify it as investment property and then IAS 40 will take the charge. So till it is completed, the cost calculation can be done under IAS 16. Okay. Now come to next special situation is investment property is acquired on deferred payment basis. That means the payment is made in installments, which means the installment will include some interest also. So what the standard says, in that case the cost of the investment property will be the cash price. Cash price means the present value of all future cash flow. Interest portion will be accounted separately on accrual basis. Here we have to solve one small example in the notes itself. X Limited acquired an investment property under deferred payment plan. Down payment on the date of acquisition is 50 lakh. After 6 months, you have to pay 1 crore 20 lakh. Again, after 1 year, you have to pay 5 crore. The incremental rate of the company is 11% per annum. Okay. Find out the cost of investment property at initial recognition. And how should X Limited account for the difference? Pass the journal entries. Now, in this question, the payments are made half yearly. The installments are paid half yearly. You are paying 1.20 here, 5 CR here, crores. Interest rate is 11% per annum. This is one period away from today. So will you apply 11% or 5.5% for this? And what about this? Again 5.5%, but we'll treat number of half years as 2. I can't use 5.5% for one cash flow and then 11% for another cash flow. For both I will take 5.5%, but here it will be 2 half periods. Okay, so write down, and this you are going to pay now only, so it will be same, right? And just check the answer also. First write down step 1, calculation of cash price. Step 1 heading, right? Calculation of cash price. Year, cash flow. If it is 11% per annum and you are making payment on 6 monthly basis, then divide the discount rate by 2, 5.5%, and use the same for both the second installment also. This is 1 period away, this is 2 periods away. Okay, so this is 50 lakh, 0.5 year, 1 crore 20 lakh, 1 year, 5 crore. Just take on your calculator, 1 divided by 1.055 equal to, is it 0.9479? Again press equal to one more time. 0.8985 90. Yes or no? Write 0.8985 or 0.90 write down. That is wrong. You make it 0.8985. Both should be same factor. Now this is right, 50 lakh. Check this one. Is it right? 11374,408. This will change slightly. Try 5 crore into 0.8985. And what is the total now? 6 crore 12 lakh 99,800. Oh, okay. You have taken all digits. Then this figure is different. How much is that? No problem. It should be consistent. Paper checkers are not smart like you. Okay. So 612,99800. Now write a note. The investment property will be valued at the investment property will be valued at 612,99800. The difference of rupees. Now what is the total of this column, cash flow column? 6 crore 70 lakh. So take on your calculator 6 crore 70 lakh minus 612,99800. 57 lakh 200. So the difference of 57 lakh 200 is treated as borrowing cost. Now accounting treatment is explained below. This you need not write, just write down directly journal entries. Journal entry on day 1. On day 1 we will capitalize the investment property. Year 0, right? Investment property account debit this figure 612,99800 to bank account 50 lakh. This is your down payment. To payable account balancing figure. Check the balancing figure is how much? 562,99800. Answer is not over. You have to pass entry for 2 more installment. Now this is your, you can say, amount outstanding on which you will calculate interest for 6 months. Means multiply by 5.5%. Multiply by 5.5%, that number 30,96,489. So write down the entry. Borrowing cost account debit to payable account 30,96,489. And then you make the payment. Payable account debit to bank account. What is the first installment? 1 crore 20 lakh. 1 crore 20 lakh. Now after passing these entries, what you will have to do on your calculator, check what is the balance left in payable account. First you type this number 562,99800. Then you add 30,96,489 and then you minus deduct 1 crore 20 lakh, 4 crore 73 lakh. Keep on your calculator. But I need to pay 5 crore. So the difference will be treated as borrowing cost for the next half year minus 5 crore equal to. So what is the difference now? 26 lakh 6,796. So this will be like a balancing figure. Is it right? No, we have to. No need to take percentage. Take it as a balancing figure. Percentage will be little different. Some difference will be there. You take such a number that after paying 5 crore, the balance should become 0. Okay. Is the balancing figure 2606,796? So that the total becomes 5 crore. Oh, once again, 2603,7 double. This will make the total 5 crore, correct? So this is the balancing figure. To get a balance of 5 CR in payable account. And if you do the calculation, there is a difference of few thousand rupees. Okay? Because you have rounded off the discounting factor to 4 digits. And this amount is huge, 5 crores. So even a small fourth digit difference will cause a difference of some 1,000 rupees. Payable account debit to bank account. Is it right? And write one more note below. Borrowing cost will be recognized in SOPL. All borrowing cost will be recognized in SOPL. All borrowing costs will be recognized in SOPL. There is one question number 6 below after this question 5. Solution is also printed. We'll quickly discuss it. X Limited purchased a land worth $1 crore. It has an option either to pay full amount at the time of purchase or pay it over 2 years for a total cost of $1 crore 20 lakh. What should be the cost of the building under both the payment method? So the answer will be in both the method, the answer will be 1 crore only. However, in the option 2, $20 lakh will be treated as interest expense and will be recognized over a period of 2 years depending upon the outstanding balance. Is it right? So only a note is required, calculations are not required. Now we'll come to next special issue. Investment property is acquired in exchange for non-monetary consideration. So exchange of one asset against another asset. Same principle of IAS 16 will apply. If an investment property is acquired in exchange for non-monetary consideration, so you acquired a building, you might have issued some securities or some other asset or inventory or service or a combination of both monetary and non-monetary consideration. Some payment in cash and some payment in the form of asset. Then it shall be valued at its fair value or the fair value of the asset given up. So normally what we do, we apply the principle fair value of the asset given up or the fair value of the asset acquired, whichever is more clearly evident. Okay. But this fair value principle you will not apply if the transaction lacks commercial substance. Transaction lacks commercial substance means the cash flow does not get affected before and after the transaction. The cash flow is not affected before and after the transaction. Like for example, you have acquired one investment property and in the same building there is another investment property. So these two you have exchanged. Two parties have exchanged these two investment property. They were just next to each other and it is not going to affect any of their cash flows. Then the transaction lacks commercial substance. Then don't apply fair value. Then don't apply fair value means what will you do? You will record the asset acquired at the carrying amount of the asset transferred. And second, when you can't calculate the fair value of both the asset, fair value of neither the asset received nor the asset given up is reliably measurable. Okay. Suppose this asset has been exchanged against this asset, but fair value of neither can be calculated reliably. then the value of the asset acquired will be recorded at the carrying amount of the asset transferred. Okay. It is same like your IAS 16. In this context, carrying amount is the amount at which asset is recognized in the statement of financial position. What about property interest held under a lease? So refer IFRS 16, or you can write or IAS 17, whichever is applicable to your exam. An investment property held by a lessee as a right of use asset shall be recognized as per IFRS 16. Now, subsequent expenditure. We have purchased the investment property, acquired or constructed the investment property. Maybe after some year, we may have to incur some repairs, maintenance, replacement, painting it again. What about those subsequent expenditure? So, what the first principle here it says the expenses incurred for services are normally charged up to profit or loss under the head repairs and maintenance. But again, they have used the word normally. If it justifies to be capitalized, then in that case we'll capitalize it. For capitalization purpose, two condition needs to be satisfied. The expenditure will generate future economic benefit to the entity and the cost can be measured reliably. Then you can capitalize the expenditure. Otherwise, normally for investment property, we will charge off to repairs and maintenance. What about cost of the replacing part of the investment property? Shall be added to the carrying amount of investment property. Same like your IAS 16. Replacement of a major part, you capitalize it, and the carrying amount of that part which has been replaced will be derecognized according to derecognition principle. So you can just mention there, refer IAS 16. There we have taken some examples also. Here also we'll take one or two simple example. Come to next question. X Limited owns a building which is used to generate on rental. Building has a carrying amount of rupees 50 lakh. X Limited recently replaced interior wall of the building and the cost of the new interior wall is 5 lakh. The original walls have a carrying amount of rupees 1 lakh. How X Limited should account for the above cost? Right. What about this 5 lakh? Capitalize. This 1 lakh derecognize. So what will be the revised carrying amount of this building? 54 lakh. So write down the answer. You want to write fully or only briefly? First you read this much at least. Under the recognition principle, an entity recognizes in the carrying amount of an investment property the cost of replacing part of an existing investment property at the time that cost is incurred if the recognition criteria are met and the carrying amount of those parts that are replaced is derecognized. So that is already printed in the notes. So write down X Limited should add the cost of the new walls. X Limited should add the cost of the new walls and remove the carrying amount of old walls The new carrying amount of the building will be equal to 50 lakh plus 5 lakh minus 1 lakh, 54 lakh. If such question comes in the exam, then you must first write the principle if you can. Okay. And then show the calculation part. Wherever possible, you have to write the provisions of the standard first. Okay, one more little lengthier question now. X Limited acquired a land for rupees 15 crore and constructed building at a cost of rupees 40 crore to be used for letting out for commercial and residential purposes under varied lease terms. Interior walls in the common spaces were decorated at a cost of rupees 120 lakh. The useful life of the building is estimated at 50 crore. So land you don't have to depreciate. Building you will depreciate over 50 years, and interior decoration will be 15 years. After 10 years, the entity changed the interior decoration at a cost of rupees 1.5 crore. So this is the cost of replacement. And estimated new useful life is 15 years. Find out the depreciation charge during 1 to 11 years. First 10 years you will calculate depreciation on building and this interior wall whose life is 15 years. But from the 11th year onwards, you will calculate the depreciation on building as usual, and this new asset which is capitalized, its useful life is 15 years. And show the accounting entry for the replacement of the interior walls. Show the accounting entry for the replacement of the interior wall. First, you will try how much depreciation you will charge in the first 10 years. First 10 year, you write in your notebook somewhere, we'll check whether you are right or not. And how much depreciation you will charge in the 11th year. In the 11th year. Write down yourself in pencil somewhere so as to test your intelligence. Written both 1 to 10. How much will you charge? 11th year. How much will you charge? And what about the journal entry for replacement of the interior wall? Old wall will be de-recognized. New wall will be recognized. Okay, check. By this time you must have done. So write down. What about the journal entry? We have not written. Okay, we'll discuss. First, write down land is separately recognized at a cost of rupees 15 crore. Land is separately recognized at a cost of rupees 15 crore. Full stop, continue. It is a non-depreciable asset. It is a non-depreciable asset. What is the total cost of this building? 40 crore, which includes interior wall of 1.2 crore. Building is recognized with components. Main asset 38.8 crore. And interior walls at rupees 1.2 crore. Written? Right. We have to complete this chapter today. Componentization accounting we are following. Question is not very clear whether this 40 crore is inclusive or not. Accordingly, your answer will change. You write an assumption, whatever you want to assume. This question should have written the total cost of building is 40 crore, including the interior decoration cost. But that is what the exams are all about. Everything is not clear in the exam also. Now write down the company applies straight line method. Again, I have written assumed, or you want to assume WDV, SLM. Okay. For depreciating the building over 50 year. So take your calculator, 38.8 crore divided by 50. Be little active. It comes to 0.78 CR per annum for building. And the interior wall, take 1.2 divide by 15. 0.08 CR per annum. Now during the 11th year, the carrying amount of interior wall is derecognized. The carrying amount of interior wall is derecognized and charged to SOPL, right? SOPL. And the new cost of rupees 1.2 CR is recognized. New cost of 1.2 CR is recognized. And one more line write down. The new cost is depreciated over 15 years. Applying SLM. That is, what is the cost of this new 1.5 CR divided by 15? How much it comes to? 0.10 CR per annum. First entry will be P&L account debit to building interior walls in bracket. What will be the value of this interior wall after 10 years? You are depreciating it 0.08 CR per annum. How many years are over? 10 years. So it will be 1.20 minus in bracket 10 into 0.08. This much you will derecognize. How much is this final figure? 0.40. 0.40. So 0.40. This is my first entry. Derecognition of old interior walls. And second entry, building account, new interior wall debit 1.5 to bank account 1.5. Done. Journal entry written. Good. So this was about replacement. So subsequent expenditure also we have done. So we have learned the meaning of investment property, initial recognition principle, and subsequent expenditure accounting also. Now one important part of this chapter is what is the accounting model you will follow. So this standard gives you two choices. You can either follow cost model or fair value model. Fair value model is different from revaluation model under IAS 16. Okay. Revaluation model and fair value model are not exactly equal. In revaluation model, gain is recognized in revaluation surplus. Under OCI. In fair value model, gain is recognized in profit and loss. Profit or loss. ठीक है? Second difference is depreciation is provided. In revaluation model, depreciation will be provided. Fair value model, depreciation will not be provided. Only you have to just keep on calculating the fair value. Change in fair value itself will be transferred to SOPL. If the fair value goes down, P&L account. But here you have to calculate the depreciation also, right? The policy should be applied to all of its investment property. Now here again there is one more difference in this standard and IAS 16. In IAS 16, for one class of asset I can follow cost model. For another class of asset I can follow revaluation model. Here it says the policy will be applied to all of its investment property. So if used cost model, all investment property cost model. Fair value model, all investment property at fair value model. And one more thing which is probably not written, you have to preferably follow fair value model only. Cost model is rare. That is when fair value cannot be ascertained, then you are allowed to follow cost model. So in general, the company will follow cost model only. Fair value model only. Now next is, what is a cost model? Cost model is simple. Capitalize the asset at cost initially and subsequently you depreciate it. And impairment loss if any. Same like IAS 16. Okay. Same like your basic accounting that you have learned for any property. Now there is one small question printed below which we will read and discuss. Answer is already given to you. No need to write anything. On 1st April 20X1, an entity acquired an investment property building for $40 lakh. Management estimate the useful life of the building as 20 years from the date of acquisition. Residual value is $2 lakh. Management believes that SLM method reflects the pattern in which it expects to consume the building's future economic benefit. What is the carrying amount of the building on 31st March 20X2? So how many years are over? 1 year is over. This is cost model. First you capitalize at 40 lakh and you depreciate. Depreciation will be equal to cost minus residual value upon number of years. 40 minus 2 divided by 20. Is it 1,90,000? So therefore the carrying amount will be 40 lakh minus 1,90,000 equal to $38,10,000. This is cost model. Such questions they don't ask in the exam, okay? This is only for understanding the concept. Now next is fair value model. This standard also allows you to follow fair value model. So an entity selecting fair value model should measure all of its investment property at fair value. Once an entity measures investment property at fair value, it should continue to do so. That means change is not allowed except in exceptional situation. So it will continue to follow fair value model until disposal or the property becomes owner occupied property or the entity begins to develop the property for subsequent sales. That means it converts into inventory. Okay. That is called fair value model. Once you select this model, continue to follow it. Change from fair value to cost model is normally not allowed. When it is allowed, only in rare exception, change from fair value model to cost model is permitted, and it is assumed that entity can determine the fair value on a continuous basis. I'll explain this last two lines. It is assumed that the entity will be able to determine the fair value of investment property on a continuous basis, and therefore they are saying once you choose the fair value model, you follow that. But suppose for any reason in future you cannot calculate the fair value, then you will follow the cost model. You will move from fair value model to cost model. But it is assumed that you will be able to determine the fair value on a continuous basis. While determining the fair values, double counting is to be avoided in case of assets and liabilities that are recognized as a specific asset or liability. Now understand this last paragraph. Now this is my building, okay? And in this building you have, say for example, a lift. Then you have air conditioner unit also. Inside the building you may have electrical equipments, fan, furniture. If you have calculated the fair value of this entire building, including all these furniture, equipment, AC, lift, and then again in your balance sheet or in your SOFP you are showing furniture, lift, equipment, fan, electrical items, it will be double counting. Is it right? So what you will do, you will remove these items because they will be accounted under IAS 16. Lift, AC, fan, furniture, and the remaining amount will be allocated to the fair value of the building. Is it right? While determining the fair value, double counting is to be avoided in case of assets and liabilities that are recognized as specific assets or liabilities. So there is one example which is given in IFRS itself. The fair value of a leased furnished office. Leased furnished office will normally include the fair value of the furniture also. In this situation, it should be ensured that the furniture value is not counted twice because it is included in the fair value of that furnished office. Plus, you are going to disclose it as a separate asset. So then the furniture will get accounted two times. Second example, again given in the standard only, equipment such as lift, AC is often an integral part of the building and is generally included in the fair value of the investment property rather than recognized separately as property, plant and equipment. So if this lift or AC, which you can treat it as an integral part of the building itself, and the building is valued at fair value, do not again recognize lift or AC as a separate asset in the financial statement. Now paragraph next. Investment property that is classified as held for sale. Which IFRS we are going to refer? IFRS 5. Because in IFRS 5 there are some conditions given. When can a non-current asset be classified as held for sale? Is it right? Like for example, I am going to give some brief hint and then we'll discuss it in another standard IFRS 5. Management should have made up its mind to sell that asset. Sale should be completed within say 12 months from the end of the period. Then management should actively look for the buyer. Okay, the management does not have the intention to reverse its plan, decision. So if this condition, and the asset should be in a ready to sell condition. That means if some buyer approaches today, you should be in a position to sell it. If all these conditions are satisfied, welcome. It is an asset held for sale. And then it will be valued at carrying amount or fair value less cost to sell. Is it right? Whichever is lower. That we'll discuss in a separate standard. IFRS 5. Oh, answer has already appeared. Remove the answer. Question number next. Which IAS or IFRS is applicable? 1. Land and building held as inventory. Buying, developing and selling for short-term profit. 2. IAS 2. Land and building held for production, storage, distribution, service, administration purpose. IAS 16. Write down the answer. IAS 2 and IAS 16. You're already valuing it at fair value, na? So if you're valuing it at fair value, if there is a decrease in value, that goes to P&L account. Matching concept is Tata bye bye. Okay. If it is fair value, then you don't provide the depreciation on fair valued investment property. So matching concept may not be given full justice here, but that is how the standard says. Because if there is a decrease in value, then that gets charged to profit and loss statement. The objective here is not to use it for selling purpose, or sorry, not used for producing goods and service. The objective is just to make a capital gain out of it. So it is similar to your investment. In case of investment, we don't provide depreciation. It is just an investment in the form of a real estate rather than investment in the form of a share. Okay. Matching concept is not required. Again, the reason can be that you're not using it for producing any goods or service. Like investment is giving you interest or dividend. So this gives you rent. Investment gives you capital gain. This also gives you capital gain. Your question should be, in case of cost model, why we provide depreciation? Earlier there was no depreciation under cost model, but then over a period of time, now they have thought if we are following cost model, then it should be accounted like property, plant and equipment, and then provide depreciation also on that. But as I said, cost model is rare under IFRS. So long as you can find out the fair value of a property. And in today's world, finding fair value of a property is not a difficult task. There are independent valuer. They can do the justice to the valuation. So mostly those companies which follow IFRS, they will follow fair value only. Okay, now one more test for you. First you try. You just have to write down name of the standard which you will follow. Name of the standard which you will follow. IAS or IFRS standard. 10 seconds will be allowed to you. Take a pencil and write. If you are very confident, use pen. Ten seconds over. Check how many of these you got it right. There are 7 questions. So the answer is one by one. Land held by CA Limited for future sale after some 5 years. As 40. A vacant building owned by CA Limited and to be leased out under an operating lease. As 40. Property held as a wing of real estate business. IS 2, because the objective is to sell. Normal course of business. Normal course of business, IS 2. Property held by CA Limited as a warehouse to store goods. Is it IS 16? Land, building, furniture fitted provided on rental basis. So you will say IS 40 for land and building, IS 16 for furniture. Is it right? S1, a subsidiary of CA Limited, lets out a property to S2, again a subsidiary of CA Limited, under operating lease basis. This question I had taken today. For S1 IAS 40, this question we have taken. For S2, asset is not recorded. And for the group CFS purpose, IAS 16. Okay. What was that question number where this same problem had come? You can mention that question number. And then one question where I said I will ask you later. 50% of the property is let out on rental and 50% is used for your own service relating to consultancy business. Also, the property cannot be separated. Now it is 50-50. So the standard says in this case you are using a significant proportion of the property. 50% is significant. And the property cannot be sold independently. So the answer is, as significant property is used for own business, it is not covered by IAS 16. It will be accounted as OOP. Not covered by IAS 40 means IAS 16 will apply. Okay, so whenever it is 50-50 kind of situation, half day used for own purpose, half day rental, IAS 16. 6 month used for own purpose, 6 month rental, IAS 16. Partition is created and half of it is used for own purpose and half it is used for rental. IAS 16 will apply if the property cannot be separately sold out. Okay. One more question for you. Try yourself. Only write the name of the standard, number, name, whatever. Try yourself. This will develop your thinking. A hotel owned by CA Limited and appointed an external party lucky firm for providing hotel management services. CA Limited is not responsible for the hotel services, as will be undertaken by lucky firm. Advise CA Limited as to which IFRS is applicable. 40. But we had taken a similar problem earlier. This time it is a passive income here. You give that entire building to this company and you will get some money out of it. So it is IAS 40 will apply in this example. Earlier example, it was actively involved. Okay, you are responsible for the services. You are doing quality check on services. Now nothing. Sit home, enjoy the money. The hotel services are not provided by CA Limited. If CA Limited was actively involved in hotel services, then it would be classified under IAS 16. Then it would be classified under IAS 16. Written properly. Okay, now we'll discuss about transfer. Transfer from one category to another. For example, 4 transfers are possible. Owner occupied property to investment property. Owner occupied property to investment property. Inventory to investment property. Third, investment property to owner occupied property. And investment property to inventory. Is it right? OOP to IP. Possible? IP to OOP. And then inventory to IP and IP to inventory. Okay. So now when you are going to convert this into this or vice versa, At what amount the investment property will be recognized? At what amount owner occupied property will be recognized? Or the inventory will be recognized? It depends on whether you follow cost model or accounting model. Is it right? So you will find in your notes we have written A when the entity uses the cost model. Cost model is easy. When an entity may be faced with a need to convert an investment property into owner occupied property or vice versa, such action will be called transfer. If it is cost model, then this line is applicable to you. Transfer between investment property, owner occupied property and inventory do not change the carrying amount of inventory because all of them are held at cost. So whatever is the carrying amount of one becomes the carrying amount of the other one. Is it right? But still we will go into more details now. Case 1, when the entity uses the cost model. Write down, transfer to and from investment property shall be made when there is a change in the use. Now, can management just like that change the classification? The answer is no. There must be a valid reason for the change, and that valid reason is change in the use of that property. You had an office, now you want to retire, go to Goa and enjoy rest of your life, and that office you have rented out to your article now. Okay, so you are moving from owner occupied property to investment property. Or you are an article, you became CA, you asked your boss, you go to Goa. Is it right? Earlier you took it on rent, and now you want to convert into owner occupied. Or you ask your tenant, you please vacate, I have to start my office here now. So let us write down. Investment property was at cost model. Transfer to owner occupied property, OOP, effect. Now here also I am following cost model. Cost minus depreciation minus impairment loss. So you don't have to do anything. Whatever is the carrying amount here will become the carrying amount of OOP. Deemed cost for fixed asset will be the carrying amount of IP. Okay. Will there be any gain or loss? Depends on NRV. Not NRV right now. First point. Both will be valued at the same amount. Only the classification will change in the SOFP. So on the day of change, there is no gain, no loss. Then investment property was cost model and inventory. Deemed cost for inventory will be carrying amount of investment property. Inventory will be valued at this amount, carrying amount. Of course, if the NRV of the inventory is lower than the cost, then there may be a need for gain or loss recognition. What is the third possibility, right? Owner occupied property to investment property, same thing. Owner occupied property to investment property. Investment property will be at carrying amount of fixed asset, carrying amount of PPE. IP will be at the carrying amount of PPE. Fourth, write down inventories. Inventories to investment property, IP. IP initially held as inventory. IP is initially held as inventory. So which standard you are following till now? IS2. Under IS2 there are two possible valuation of inventory, hence carried either at original cost or even NRV. So inventory was appearing in your books either at cost or NRV in bracket. Inventory is not depreciated. No depreciation. But if you're going to convert into investment property, it will be transferred at cost minus provision for depreciation. So if this inventory was purchased say 3 years ago, and now after 3 years you want to convert into investment property, then you need to provide depreciation for those 3 years. Any difference between the carrying amount of inventory and cost minus depreciation will be recognized in profit and loss. On this point, we'll take one example because some calculation will be involved here. Solve question number 13 below. ASF Property Holdings engaged in buying and selling properties on large scale. So what is their present model? The real estate is inventory for them. Property X was purchased on 1/4/14 at rupees 50,000, including all other expenses. Every year the NRV was 20 to 25% more than the cost, which means it is inventory and it is carried at cost only. The property will be depreciated over 25-year SLM, salvage values 40%. On 1/4/17, the entity decided to reclassify the property as investment property to be let out on rental basis. Instead of doing the trading in that, now you want to use it for rental. Comment on the reclassification. So my question is, what is the carrying amount of investment property? You will take 50,000, provide depreciation for how many years? 3 years. 50,000, your salvage value is 40%. 50,000 minus 40%. Divide by 25 years. 1,200 into 3 years. 3,000. So 50,000 minus 3,600. 46,400 will be the value of your property. Okay. And the journal entry will be profit and loss account to property X 3,600. Write down. We will assume that NRV on the date of reclassification was higher than the cost. That is given. Is usually higher than the cost, it is given. Property X is inventory. Write in detail. Property X is inventory, hence the valuation will be at cost or NRV, whichever is low. Cost or NRV, whichever is less. But as the NRV is always higher than the cost, as the NRV is always higher than the cost, the inventory will be kept at cost. That means the book value of the inventory right now is 50,000. The purpose of this paragraph is that in order to get this P&L account figure, I need to compare 46,400 with the book value of inventory, which means book value of the inventory now is 50,000. On 1/4/17, for asset reclassification, we should bring the asset to we should bring the asset to cost minus provision for depreciation. No, that is the value, cost minus provision for depreciation. And now next line is calculation of depreciation. So next line item, cost minus provision for depreciation equal to 50,000 minus, see the calculation in bracket, 50,000 minus 40%. This should be minus sign here. Minus 40% divide by how many years? 25 years into 3. 50,000 minus 40% divided by 25 into 3. Final answer will be 46,400. This figure is depreciation. If you calculate, it will come to 3,600. So journal entry, P&L account debit 3,600 to property X 3,600. Okay. Okay, one more you will try in the book only. Now the answer is printed. Moon Limited has purchased a building. We'll read from the book only. Question 14. Kindly pay attention to question 14 printed below. Moon Limited has purchased a building on 1st April 20x1 at a cost of $10 million. The building was used as a factory by Moon Limited and was measured under cost model. So what is the original classification? Owner occupied property. And you are following cost model. The expected useful life of the building is estimated to be 10 years. Due to decline in demand of the product, company does not need the factory anymore and has rented out the building to a third party from 1st April 2005. How many years are over? 4 years are over. So how much depreciation you must charge? 10 divided by 10 into 4. 4 million you have charged. So your carrying amount right now will be 6 minus 4. That is, 10 minus 4. Na? 6 million is the carrying amount right now. And the standard says if you are following cost model, then same will become the carrying amount for investment property also. On this date, the fair value of the building is 8 million. Ignore it. Moon Limited uses cost model for accounting of the investment property. What is the amount at which building will be initially recognized as investment property? So the answer will be 6 million only. And then there have long explanation given to you, which you need not write so much in the exam. Carrying amount of the building after depreciation for 4 years. Same 10 minus 10 upon 10 into 4, 6. Company has been applying cost model. There is no impairment of on the as the fair value is greater than the carrying amount of the building. So the purpose of giving recoverable amount was to check whether it is impaired or not. No impairment. Revaluation surplus. No revaluation surplus because there is a cost model. Building initially recognized as investment property using cost model will be 6 only. Is it right? This you have learned. Cost model. Easy. Now we will see fair value model. This standard permits you to follow fair value model for investment property, which is in general what you will follow. You will follow cost model only when fair value cannot be determined. Okay. For a transfer from investment property carried at fair value to owner occupied property or inventory, the property is deemed cost for subsequent accounting in accordance with IAS 16, IFRS 16 or IAS 2 shall be its fair value at the date of change in use. So what will be the deemed cost in case if the fair value method is followed for investment property? The fair value on the date of change in use, fair value on the date of change in use will be the deemed cost for subsequent accounting. Okay. Then you follow IAS 16 or IFRS 16 if it is a leased asset, or IAS 2 if it is inventory. But what will be the starting point on the date of change? The fair value on the date of change in use. If an owner occupied property becomes an investment property, now this is OOP to IP, and IP will be measured at fair value. An entity shall apply IAS 16 for owner occupied property and IFRS 16 for property held by lessee as a right of use asset up to the date of change in use. So up to the date of change, let us put some date 1/4 suppose 2020. Up to this date you follow respective standard. Okay. Any difference on that day between the carrying amount of owner occupied property and the fair value of this investment property will be treated as a revaluation in accordance with IAS 16. It will not be treated as P&L account gain item. It will be treated as revaluation gain or loss. Because what was the standard you were following earlier? IAS 16. So it will be treated as revaluation surplus for this difference, and it will be routed through OCI. Okay. The valuation surplus will not be immediately transferred to retained earning. Then they could have directly transferred it to retained earning only. You have to dispose that investment property, then you transfer it to retained earning. Okay. Otherwise, there is no need of revaluation surplus only if I have to transfer it to retained earning immediately. It will be transferred on disposal. Otherwise, you can use this as a device to increase your retained earning in case if the investors are crying for more dividend. Then you can just, for some reason, you can change the classification, create retained earning, and use it for dividend payment. That is why they said you keep it in revaluation surplus. No. See, management is smart. They need to create profit somehow to satisfy their investors. In the name of reclassification, they can create the profit. So that is why they said you can't do that. Keep it in the revaluation surplus. And what about decrease? Decrease is your loss. So decrease will be transferred to profit and loss. However, you have learnt in IAS 16, if an asset is revalued earlier, upward, and then there is a decrease, then the decrease is recognized in other comprehensive income and reduces the revaluation surplus within the equity. What about the resulting increase in the carrying amount? To the extent that increase reverses a previous impairment loss. Earlier, this same asset was revalued downward, and now there is a gain. It will first use to reverse an impairment loss for that property. The increase is recognized in profit or loss. The amount recognized in P&L account does not exceed the amount needed to restore the carrying amount to the carrying amount that would have been determined had no impairment loss been recognized. So there is an upper limit on how much you can transfer to the profit and loss. The amount you will transfer to P&L account should be such an amount that after reversing that amount, it should not exceed the carrying amount which would have been determined had you not provided the impairment loss. Suppose an asset was at 1 lakh. You have revalued it downward to 60,000 earlier. Had you not provided the impairment loss, what would have been the carrying amount of the asset today? Suppose the carrying amount of the asset today would have been 65,000 only. Then this you can reverse in such a manner that after reversal, it should not exceed the carrying amount that would have been determined. What about any additional amount that you have to reverse? That any additional amount that you have to reverse will be treated as revaluation surplus. If in my previous example, suppose I have to reverse more than 5,000, then excess amount will be routed through OCI, revaluation surplus. The remaining part of the increase is recognized in OCI and increases the revaluation surplus. On subsequent disposal, underline your query. On subsequent disposal, the student had asked the query, can I transfer immediately to retained earning? The answer is no. It says on subsequent disposal, the revaluation surplus included in equity may be transferred to retained earning. The transfer from revaluation surplus to retained earning is not made through profit or loss. Now we'll come to inventory to investment property. Inventory to investment property and investment property is carried at fair value. Now in this case, since the original classification is inventory and now it is investment property, the difference will be transferred to profit and loss. But from OOP to investment property, gain will be shown in revaluation surplus. But from inventory to investment property, the gain will be shown in P&L account. Now one more paragraph before I take a summary of this long discussion. When an entity completes the construction or development of a self-constructed investment property, you are constructing a property, okay? So till you are constructing, it will be accounted like IAS 16. Add all the costs, keep adding. Now it is ready. And once it is ready, you want to treat it as investment property. And you want to treat the investment property at fair value. What about the difference between the book value and the fair value? The difference will be recognized in profit and loss. Okay? Yes or no? So capital WIP, when becomes investment property and the investment property is valued at fair value, the difference will be shown in profit and loss. Haji, your query. Entity uses cost model for recording investment property. Which will remain in OCI only. If owner occupied property is converted into investment property and there is any revaluation surplus, it will remain in revaluation surplus only till the disposal. Yes. Okay, so what I have done, this above few paragraphs were directly copied and pasted from IFRS or IAS 40. Now the summary of that is like this. If fair value, investment property at fair value, investment property carried at fair value to owner occupied property or inventory, the properties deemed cost for subsequent accounting will be as per IAS 16, IFRS 16 or IAS 2 shall be its fair value on the date of change. Here we are moving from investment property to other two categories. But if owner occupied property is converted into investment property, then in that case, a difference will be either treated as revaluation surplus in case of gain or will be transferred to profit and loss in case of loss. However, if the asset is previously revalued upward or downward, accordingly the treatment will be given. And if an inventory is converted into investment property, which is carried at fair value, then the difference between the fair value of the investment property and the carrying amount of the inventory will be recognized in profit and loss. There is one example also I have given in your note. A building depreciates and has a net depreciated carrying amount of $75,000. So this is right now OOP. It is transferred to investment property at fair value of 1 lakh. So OOP to IP. IP is measured at fair value. The difference will be 25,000 and will be accounted as revaluation surplus. Okay. These all small discussion will form part of a bigger problem also. Now next is retirement or disposal. The investment property will be derecognized. Okay, that is eliminated from SOFP on disposal, and when it is permanently withdrawn from use and no further economic benefits are expected from its disposal, then it will be derecognized. Disposal can be either through sale, very simple, or it can be disposed through entering into a finance lease. In finance lease, the seller will derecognize the asset, or what you can say, lessor would derecognize the asset. Next point, the date of disposal for investment property that is sold is the date the recipient obtains control of the investment property in accordance with the requirement for determining when a performance obligation is satisfied under IFRS 15. Not very important. It says the date of disposal will be determined as per IFRS 15, revenue. Under revenue standard, you will see when is the revenue to be determined. Okay, when the performance obligation is satisfied. And in case of asset given on lease, IFRS 16 applies to disposal effected by entering into a finance lease and to a sale and lease back. So that is IFRS 16 for lease and IFRS 15 for sale, for determining the date. Okay. What about the treatment of that gain or loss? The gain or loss will be transferred to profit and loss. And on disposal of an investment property, if there is any revaluation surplus, that will be transferred to retained earning. Okay. At the time of purchase, we have discussed investment property can be acquired on deferred payment basis. Exactly reverse of that. Investment property can be sold on deferred payment basis. One example we had solved today. Which example? Deferred payment example. Quickly answer. Problem 5. Today you go home and reverse that question. Okay. Instead of purchase, you assume you have sold and pass the entry. Can you do that? Any deferred receipt of net consideration will be bifurcated into cash price and interest portion. So question 5 is your homework. Assume it is now a sale transaction. Compensation from third parties. Compensation from third parties. One more homework, note down question number 15. Question number 15. Okay. Accounting entries relating to depreciation, relating to disposal. You will be able to solve? Sure. Okay, now come to one more paragraph. 22. Compensation from third parties. You may have taken an insurance cover to protect your building. There is a loss due to fire, earthquake, which was covered by insurance. First, you will recognize the loss. Okay, impairment loss. Thereafter, you will recognize the compensation from third party when the compensation becomes receivable. We have solved a similar problem in IS 16 also. You can refer that. Only you can change the name of the asset from machinery to investment property. So I'm not taking the same question again. Now we will continue tomorrow. The long disclosures that is printed we'll discuss tomorrow. If required, we'll take one or two more questions and we'll start a new topic. Try to solve the remaining cell practice problems also.